Well, I think one thing, the viewers need to keep in mind is that just because the calendar year changed doesn't mean that the strength that we saw throughout 2024 suddenly has evaporated. There are tailwinds building because the Fed is dovish, even if they're making fewer cuts. But I think one of the sort of two important things happening early in 2025 is going to be, one, we are seeing manufacturing recover. The ISM manufacturing, posted one of the highest readings in almost 2.5 years. I mean, it's been below 50 basically for nearly 3 years. And the second is that I think the labor market could be softening in a way, because whether you look at link-up data or the ISM employment, to tell us that the Fed now has to be focused back on supporting the economy. So I think this month could be quite decisive in the sense that we've got weakness because of some insecurities building, but I think it's, the same tailwinds are in place. I mean, I think it's still a buy the dip kind of market. Investors still are going to pay for earnings visibility, and that's why I think the Mag 7, including NVIDIA, are going to be important holdings. But financial conditions should ease this year. Easing financial conditions does allow some cyclicals to post better earnings growth, like financials and regional banks, industrials, and small caps. So I think that there should be a case for broadening of the markets this year. And then finally, I think in terms of risk appetite, still one of the good measures to look at how risk appetite is to look at something like Bitcoin, and at 97,000, it's still telling us that, this is still a risk-on market.
Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks were broadly mixed as the S&P 500 headed for its first record close of 2025 as traders and investors assessed Donald Trump's remarks at the World Economic Forum and some weaker than expected economic data. And today, we just saw a little bit of a digestion from yesterday in the mega caps. NVIDIA, Apple, AVGO, Google, they were all down here today. Tesla was also down 1.15%, but we did see some slight buying here in Meta, Oracle, a lot of buying, and a continuation from yesterday's trade in Netflix. Net technology was very mixed. There were winners, there were losers. Such goes the market. The broad market, however, was actually very, very green when you look at it. In fact, every single sector gained except communication services right here and technology. Both were down 0.1 and 0.3% respectively. However, every other sector gained, with industrials and healthcare leading the pack, gaining both about 1% in aggregate. All in all, we continue to see that value rotation in the market, with a rotation out of these big names into the broader market, and that's exactly what you like to see. That is why we actually saw the value side of the market outperform the growth side. You could see 0.82% in large cap value versus large cap growth, which gained 0.23%. Mid-cap core was shunned today. It was virtually flat, slightly in the red, but we did see gains in mid-cap value and mid-cap growth. However, small caps bucked the trend, with small cap growth outperforming small cap core and small cap value. Nonetheless, a broadly green day in the market, very positive for 2025. However, there was a couple of news events that did rock markets, and we did see some very volatile price action, particularly from what we saw in the morning trade versus what we saw in the afternoon trade. And a big volatile mover was actually the earnings for a company called SK Hynix. They actually topped profit forecasts, but their shares dipped on demand outlook. For those of you that don't know, NVIDIA's primary high bandwidth memory supplier is SK Hynix, right? So this is essentially a read-through for semiconductor demand. For those of you that don't know, NVIDIA makes the chips, right? Next to the chips in NVIDIA, you have these high bandwidth memory chips, right? SK Hynix makes these chips. These chips are needed. They're essentially RAM for the GPU. NVIDIA needs these chips. And if they're signaling, weak demand outlook, what does that mean for NVIDIA? And that's why we actually did see NVIDIA was down as much as 2% in the early market. They had a nice bounce off the lows. However, this is going to weigh on the overall sentiment with regards to NVIDIA's earnings and tech earnings next week and the week thereafter. Another big mover was Trump at Davos. He was speaking at the World Economic Forum. and he made some very bold claims. He came out and demanded interest rates drop immediately, not just in the US, but around the world. He also asked OPEC to bring down the price of oil. Oil slid as a result. And on the tariff front, the president offered a warning to companies, and he said, if you don't make your product in America, which is your prerogative, then very simply, you will have to pay a tariff, differing amounts, but a tariff, end quote. And that was Donald Trump's words. And that's why we really did see a lot of churn and mixed price action in the market. It was a lot of this on the tech side, a lot of this on the Donald Trump side with the broad market. And we did get some earnings that did affect market sentiment. EA Games was down 17% today. They released preliminary earnings and their stock tumbled because the game publisher said quarterly bookings fell to roughly 2.2 billion, missing analyst expectations. The market definitely did not like that. In fact, they were forecasting something like mid-single digit growth. They actually saw mid-single digit declines. So the management team in absolute shambles right now, market not liking this. And yeah, that's going to really hurt gaming stocks as a whole. GE Vernova was up 6% after the jet engine maker exceeded fourth quarter estimates on both revenue and earnings. GE also gave an optimistic outlook for the full year 2025 and announced a $7 billion stock buyback program. The street loves to see that type of earnings, especially buybacks. And then we also had American Airlines. They reported earnings and the stock fell nearly 8% after the carrier forecast a surprise loss for its first quarter. The outlook is a departure from the major air travel carriers' bullish performance in recent quarters. American had implemented changes that pushed corporate customers book directly with the airline instead of a third-party travel manager. And it seems that direct-to-consumer approach is definitely hurting the top line. The street doesn't like it, down 9%, nearly 9% today. What also did dampen sentiment a little bit was initial jobless claims. Now, we were expecting initial claims to come in at 220. We actually got 223, and this miss was attributed to the California wildfires. Nonetheless, there wasn't a massive blowout of initial jobless claims, but still a weaker number than expected. But all in all, when you look at the market as a whole, what we continue to see is shorter term trends and longer term trends continue to behave very, very well. And this is exactly what you want to see, guys. In an environment where the short term trends are looking good, the longer term trends are looking good, you want to buy any weakness. And right now, for those of you that are looking at stocks that may have missed the rally because the S&P 500 just hit a new all-time high, look for stocks, right, that are at their 50-day moving average. You can screen for that. There probably is some value around this segment of the market. So if you think you missed the rally in the S&P 500, just screen for stocks at or near their 50-day moving average. And then you could probably look at those because the second this improves right here. But all in all, market momentum looking very solid. And market breadth was actually very positive today. We actually had 3,300 advances, 2,900 decliners, so slightly more advances, but pretty much 50-50 net. And if you want to see continued market momentum, this is the type of stuff you want to see. And this is a very positive development compared to what we saw at the start of January. Now, looking at the charts, guys, we see some very interesting price action. Have a look right here. The S&P 500 gained 0.2%, the NASDAQ 100 fell 0.13%, the RSP up 0.33%. So to actually see the S&P 500 up while the NASDAQ 100 is down really goes to show the broader market is putting in a lot of work right there. Small caps gained, mid caps were down today, very weird, and profitable small caps also gained. Very interesting price developments. We saw mixed price action in the yield market. The 2-year yield fell, the 10-year and 30-year yield gained. The dollar fell as well. Interesting. And we did see bonds as a result. For the AGG and TLT were down. In fact, the TLT, that's a down 0.77%. Rough move there for the TLT. And then metals on the back of rising yields actually fell. Gold fell 0.11%. Silver fell more than 1%. And then we saw WTI and nat gas on Trump's comments for 1.55%. So Trump moving the stock markets, the commodity markets, the crypto markets, Trump moving everything at the moment. Now the S&P 500, guys, the market is still open. We have about another 10 to 15 minutes before close, notching another intraday all-time high. We'll see if we close at an all-time high, but we are pretty much at the top end of the range here. Now we haven't seen the core resistance move up, and that probably means we are going to balance here and probably find a little bit of resistance unless we actually get a move up into this week. But with OPEX approaching, I don't think we're going to see a move up in any of these. We're probably going to wait for Monday for that to happen. So expect a little bit of resistance here at the top end of this core wall and for us to probably go lower into the end of the week. That will coincide with some profit taking as well, because it has been a stellar week. We've had so far a phenomenal week, and this was also a shortened trading week, trading at all-time highs here for the S&P 500. Nonetheless, guys, you can see that this is a bull market. Look at the last year. Every single shallow dip we got, right, we simply bought. Right here, bought. And that's exactly what the market did right now, bought. And in every single instance, we took all-time highs and made new all-time highs. And this might be the first all-time high for the S&P 500 in 2025. The Nasdaq 100, very similar story, although there's a little bit more upside to get to the core resistance. So the options market saying, hey, we still can see these mega cap names run up a little bit higher, especially after the news we got from Donald Trump, the $500 billion investment. But we'll see how the options market reacts this week, especially after the SK Hynix report. Nonetheless, there's a lot of room here to run in the Nasdaq 100. And relatively speaking, if you were to pick between the S&P 500 and the Nasdaq 100, you'd probably go long NDX, short SPX, relatively speaking. However, I wouldn't really short any of these indices. I'm just saying, based on the options market and what they're telling us, if we want to get like short-term returns, we're looking at 1 day, 2 day moves in the market. Looking at the RTY, the IWM, this is exactly what we saw. We said the core resistance didn't move up. What normally happens, we tend to see a bit of a pullback if that is the case, because option sellers did not roll their contracts higher from here. So what does that mean for us and looking forward? It means we're going to see a bit of weakness. That's exactly what we saw in the IWM. If we continue to see downside momentum, guys, we want to buy the 2260 area for us to go ahead, break these highs, and continue the trend that we've seen right here in the IWM. Nonetheless, it does look like dip buyers came in a very big way. Look at that wick, and let's go on the 1 day chart and actually see. And what we saw here is we opened the day, saw some downward momentum, and then we bought the dip. And the RTY is up 0.23%, seeing a bit of consolidation at these highs. So this is probably where we will close around the day. Nonetheless, we're seeing some very bullish momentum in the RTY. But what we really need to do now is see the core resistance move up for us to go ahead, break these highs. We do that, and then we will see continued momentum in the IWM in small caps. And then looking at the RSP, this just looks really, really good right now. We are somewhat starting to form the early stages of a base right here. If we form out a very tight base, at this level right here, let's say between these levels, we form a tight base, that probably means we shoot up breakout on high volume, especially if earnings and the data comes in as expected next week. Nonetheless, there is plenty of upside for us to get to the all-time highs at 188 for the RSP. All in all, guys, what equities are telling us is they're looking poised to go higher. But what we should see in the next couple of days is a little bit of weakness. The S&P 500, we probably close at all-time highs here today, at just above the core resistance, but we probably see some downside into the end of the week. Some profit taking, it is what it is. We're seeing a little bit of downside in the Nasdaq 100, but maybe we get a little bit of upside into the end of the week. And then the RTY, we are starting to see a pullback. We can probably go ahead, touch the core resistance, but very likely to use that as resistance up until January OPEX, up until OPEX is resolved. And then we get the next move from the options market, and that will tell us what to do next in the RSP. What we really want to see is a base, and then for the RSP to make its next move higher. All in all, equities look good. We've bought the dip, and now all we really need to do is embrace the volatility, because that's what we get in earnings season with high impact data and a Donald Trump presidency. So buy the dip, hold. Volatility is what we will get in 2025. And diving into sentiment, this is the AA sentiment survey, a somewhat staple on this channel, and we've seen very interesting developments. Sentiment ticked up in a very big way this week here in bullish sentiment. We saw a huge downtick in bearish sentiment as well. And this is coming off what we saw with some of the lowest levels we've seen in the last couple of years, with bullish sentiment at 25.4%. And it was last week. Go and watch last week's video. I was absolutely pounding the table saying these sentiment readings look capitulatory, with both bullish sentiment ticking down and bearish sentiment ticking up in a very, very big way. We also saw a lot of people sitting on the sidelines right here. That is often a sign that the markets are about to make their next move. And in bull markets, we don't really stay down. Stocks, yes, pull back, but we see sharp rallies. That's a hallmark of bull markets. We are in bull markets, and what we are seeing right now is an expansion of bullish bets and a decrease here of bearish bets. And it's very obvious to see those that were bearish flipped bull, and those in the neutral camp picked a side and they sort of went into the bullish camp. And that is why we're approaching like 6-month highs in bullish sentiment here on the back of the Trump inauguration. Very bullish stuff. You love to see this in a bull market. However, even though I am bullish for 2025, I have a seasonal barometer right here that lines up with my expectations for 2025 and the S&P 500. Now, for those of you that know, my S&P 500 price target is 6669. We're looking at about 9 to 10% appreciation from where we are right now and from the start of the year. And if we actually look at this seasonal barometer right here, if they turn the year barometer, so essentially what the full year is going to do when November 19 to January 19 is less than 0.3%. And when we trigger this, like we did in 2025, we saw a 1.35% return in this time period. Generally, what the S&P 500 returns is 6.1%. Now, you may look at this and think, oh, well, these returns are very lackluster, especially seeing 12 wins, 7 losses. However, if you look at the drawdowns, we see a lot of double-digit and mid-single, high single-digit drawdowns. If that is the case, you want to buy any dips we do get, because even though we did have a lackluster turn of the year, if you buy the dip and pair it with the average return we see in this time period, what the outcome normally is strong double-digit returns, sometimes mid to low teens returns. So if we get a 5% pullback, if we get a 10% pullback, buy the dip, because we're seeing bullish sentiment. We are in a bull market and you want to take advantage of those dips because they're going to be very shallow. However, everything always goes back to the fundamentals, regardless of seasonality or even sentiment. And right now, when we look at S&P 500 earnings for Q4, things looking very, very good. We are actually beating earnings expectations by 0.7%. So the market expectation was for 9.9% in earnings. So far, we are hitting about 10.6% in earnings, which is very, very good. This number right here is actually a nominal number. We are seeing double-digit returns in the S&P 500, and we are seeing 75% of companies beating the absolute number with an 8.9% average surprise. Very bullish stuff. And guys, look at some of these energy stocks, basic materials. 100% of companies are beating earnings. Same with real estate and energy. That's not something you see every day. Healthcare too. We are seeing massive beats here for Q4. And with earnings looking at 10% plus, you want to hold equities in this environment, guys, because when earnings are growing and margins are expanding, stocks do very, very well. Now, what are management teams doing with all of this money that they're making? Right now, they're actually buying back stock. Even with elevated multiples and higher rates, corporate buybacks in January were well above the 2010 level, and buybacks are tracking similarly to last year, suggesting that management teams do not believe stocks are too expensive. And when you look at the average stock and the PE ratio of the average stock, that simply is the case. However, when you look at the NASDAQ 100 or these big tech names, things are looking very, very pricey. In 2024, the NASDAQ 100 has an average trailing 12-month PE of 34.7. Yes, very pricey, but you're getting extremely high quality companies in this index. And when you compare it to the year 2000, the PE ratio is still half of that from the peak .com era and still well below the 1999 average of 43.1. You could see it peaked out here at 68.2. So we are pretty much half of the .com bubble peak and still well below what we saw in 1999, with these companies growing earnings in a very strong way, doing literally $1 trillion in market buybacks expected in 2025. Yes, valuations are lofty, but companies actually have the earnings to back it up, unlike companies in the year 2000. But valuations can contract if the macro fails. And right now, we're not really seeing that. Both are actually increased their Q4 GDP forecast by 0.3 percentage points to 2.6%. So they went from 2.3 to 2.6. You love to see that. Robust growth above the 2.5% mark is owing to the economy we're currently in. On the back of this, what we're also seeing is that the US consumer is benefiting from rising real income. You can see the employee cost index right here and the consumer price index. We are tracking above the employee cost index. In other words, employee compensation and employee income is outpacing inflation. That means the average US consumer has now buying power against the cost of inflation. And if this continues, we should see further consumption in the months and years ahead. This is very, very good for the consumer, very, very good for the American economy. And then with regards to inflation, something that we have seen is stuff like this is the chicken wing index. In other words, just the cost of chicken wings. And you can see that food inflation has come down in a very big way, particularly with chicken. Chicken is the most consumed meat in the world. And these are some of the deflationary markers that are helping the consumer out and will contribute to stop the inflation in 2025. But the biggest one, apart from food, is actually rent, guys. And look at this right here. This is quarterly apartment rent growth in the top 50 markets. I got the data here as of January 2025, guys. So what we are seeing is like Tampa up 1.5% in the quarter. And then we have these minuscule increases in San Francisco, Palm Beach, Cleveland, Milwaukee, Norfolk. That's about it. Every other major area is seeing rent deflation. Look at these deflationary numbers. Look at Denver, Austin, Tucson, San Antonio, Salt Lake City, guys. We're seeing like negative 1.1% quarter over quarter deflation. Absolutely insane. And I think we really are going to see softer inflation numbers in 2025 on the back of deflation in food as well as rent. And that's going to bode really well for the overall consumer. 2025 rates, the dollar, and everything in between. It really all does come down to what PCE and CPI print. It really comes down to inflation, and that's really going to support the market and give the Fed the power to cut rates. And if the market starts pricing in more rate cuts with a weaker dollar, that's very, very bullish for markets. And I do think we're going to get there, but it's going to take some time. Looking at earnings for the rest of the week, guys, we don't really have much tomorrow. We just have Verizon, American Express, Nextra Energy. That's about it. We also have HCA Healthcare, a company I've been looking at quite a bit. And that's really it to cap off what was a stellar week of earnings. But next week is going to be even crazier. And then data for the rest of the week, we just have the composite PMIs, manufacturing PMIs. We just got manufacturing data tomorrow. Now, the expectation for the composite is 55.3, for manufacturing 49.6. If we hit the 50 mark, that could be very, very good. I think that will see the market rally, particularly industrials. Global services looking at 56.6. Then we also get home sales data. We're looking at 4 million homes and negative 3% month over month. And University of Michigan sentiment, we're looking at 73.2. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell as well as the like button, and leave a comment for the algorithm. Cheers.